Well, clearly the first quarter earnings are going to be very negative. And if you look at most of the estimates, American first quarter earnings are going to be down approximately 8% year on year. And I think the interesting question is whether investors look through that towards improved earnings later in the year. But I think the operative word there is it's going to be much later in the year. And obviously, after the good returns that we've had year to date, not just in the States but also in Europe, I think inevitably you're seeing some profit taking. And I think it's also fair to say, if you look at the surveys of investor positioning and investor thinking, there is a huge amount of confusion at the moment. Is inflation coming down rapidly or not? To what extent is the US economy, and for that matter the European economy, slowing down? And what are recession risks? So given those uncertainties, I think investors are reducing risk at the moment and booking, frankly, what are decent profits year to date.
Can I just focus in on two sectors? Because for most of the month of April and even back end of March, we were talking about the trade-off between FANG stocks or technology names versus banks as the height of the banking crisis hit, all that turmoil around SVB and beyond. We saw this transition back towards beaten up tech names. But the reality of the wash up now for the month is that both sectors have been hit. FANG plus stocks down 6.5%. Banking names on the KBE, not the regional, down 4.6%. So you've had a reset low on both of those names. Clearly some of this could change as we get into the weeds on the tech numbers now. But how do you think both of those areas of the markets stack up?
Well, I think you've got to distinguish what's going on in the banking sector and what's happening in the tech sector and how that loops into the debate of growth and cyclicals versus defensive and value sectors. I think, first of all, on the banking sector, I think there is one major problem in the United States, which is the average return today on US money market funds is over 4.5%. The average call deposit rate, if you place money with a US bank, is less than 1%. So it's not surprising that money is flying out of the banking sector into money market funds. In addition, money is flying out of small and regional banks, and that's not stopping, into the larger banks. And if you look at the results that we had from, for example, JP Morgan, Citi and Wells Fargo, they all had increased deposits versus lower deposit rates from the smaller regional banks. That's the issue in the banking sector.
That point about where the money sits, I think, is fascinating at the moment, Bob, because for this market to go a lot higher, there needs to be some new buyers being smoked out to start picking up stocks. And very interesting that Goldman Sachs had a piece out basically warning that the quants are out of ammo. Their argument, systemic money managers have loaded up on more than $170 billion worth of global shares in the past month, and they're tapped out. We've seen all of this money moving into money market funds. There seems to be growing reticence to put fresh money to work to push equities higher. So where is the so-called dry powder at this stage? Because surely it's not the private equity people that are going to put the money in because they're worried about the valuations of what they already own. Well,
I mentioned earlier on investor confusion, and I think that's a big theme at the moment. And if you actually look at investor surveys, just recently, the last few weeks, you've seen, if you look at money market flows and mutual fund flows, money in the retail space has actually gone back into equity markets. In contrast, the surveys of institutional investors show that they're still extremely cautious. So to answer your question, I think that the retail investor, you use the phrase tapped out. Yes, I think the retail investor probably is quite tapped out. And in addition, he is getting an attractive return on money market funds today at over 4.5%. Institutional investors, to answer your question, are sitting on significant levels of liquidity. So there is money sitting on the sidelines there. Having said that, I think that money is going to sit on the sidelines, and I think the theme really for May and June is actually going to be rotation into what has underperformed year to date, coming back to Karen's question about sectors, which is into value and defensive sectors and taking profits on cyclical and growth sectors. And that comes back to your issue on the tech sector. That has performed very well in the last 2 months. I think that's now going to see profit taking. Well, arguably it's already seeing profit taking. Is that going to continue? Yes.
But we know where